this one.
First of all, can I get an idea of how many people have done their 3 write-ups already? Oh, well, okay. Unfortunately, I think we're going to change the assignment for Thursday, which is rather than doing American Express, which if we have time I will discuss and you can turn in, but which is incredibly difficult. I thought we would do WellPoint, which is both apropos since they're in the process of screwing their customers or potential customers in California. If you followed that in the newspapers, they just raised their insurance by some 38%, which is great if you can get away with it. So I thought WellPoint would be easier to do. Now, on this last assignment, we will post a value line tear sheet for WellPoint. But mostly, you have to find the material. And the easiest and best way to do that, except for the long history, which you should have on the value line tear sheet, is to just go to the website of the company. Click on About Us or About the Company, and then click on Investor Relations. Other than that, there are lots of finance sites that also have data that will get you to the 10Ks and the annual reports. But we want you to get a sense for this assignment of how accessible things are on the web. Is that clear? So if for people who are not in class, you ought to warn them that it's going to be WellPoint, and we may get to American Express, we may not. Now, I warned you today is going to be a long class. We have a lot of material to cover. If it looks like it's going to go too long, I'd like to give you a break, but now I need an honest answer. If I give you a break, how many of you are actually going to come back? All right, almost enough. So we'll try and get through it in 2 hours, and we'll give it back to you, obviously, on Thursday when you've got party time afterwards anyway. But if it runs over, I don't want to make you sit there in these seats for that long. Now, I also would prefer not to rush things, because what I'd like to do first, since this is sort of the last lecture class here, is to review the material. And this is your final chance to ask questions. So remember where we started out. This is a basic process of investing. You have a search strategy that points you to opportunities that are likely to be undervalued. You then have an approach to valuation, which is you hope better than what other people are doing. That leads to a research and review strategy, and that leads to issues of risk management. And it's these 2 things that we're actually going to talk about today, although in fact we've talked about them to a surprising extent, as you'll find out already. What's the search criteria for a value investor? It's obscure and undesirable. That, remember, you want to be on the other side of a trade from somebody who's doing stupid stuff. In general, why does that work? Because there are individual biases, preferences for get-rich-quick lottery tickets, aversion to ugly and potential losses that causes, in the latter case, things to be oversold, in the former case, things to be overbought, which means that the flip side of that, which is the non-lottery tickets, are going to be oversold. And hindsight bias. People think they know much more than they do. They think that if they imagine something that's going to be bad, it's going to be bad for sure. That means those stocks are going to be oversold because nothing is certain in this world. They think it's going to be good, they think it's going to be good for sure. Those individual biases are reinforced by institutional behavior. If everybody's buying Microsoft, institutions that don't want their performance to be too far distant from the average, because that's what will make investors leave, will tend to buy Microsoft also in the same amounts. They also do window dressing. They pander to those individual irrationalities by buying the kinds of stocks that appeal to those people. And in particular, they talk all the time about their blockbuster investments. Are there any questions about that? Because what you're going to hear from when we bring in the first outside investors is a quant fund that is essentially based on that search strategy, and those funds outperform the market, which most professional investors, by the way, underperform substantially after fees. On average, they all can't outperform before fees. But just doing that kind of a search strategy, low market to book, low price earnings, low growth, cheap, ugly, and obscure small cap does really well. Are there any questions about that? This is your last real chance. Yes? Because you're not born that way. It's the whole point about these psychological tendencies. What fraction of the people in this class do you think are actually going to wind up doing it? Maybe 10%. Because you're going to look at these stocks and it's a famous story of a guy who first discovered these statistical things. He was a professor then at Cornell. He's now at Chicago, called Dick Thaler. And he should have showed that the stocks that had done worst over the last 3 years were the stocks you wanted to buy. And of course they were ugly and disgusting. So he tried to put together a fund from the faculty to get them to participate. And he said, whatever you do, don't look at these stocks. Because if you look at them, you'll never invest in them. They looked at them, and none of them invested. And the portfolio outperformed the market by a substantial amount. It is that fact that seems to sustain why everybody doesn't do it, and why most of you won't. So the second thing you want is a superior valuation methodology to the DCF or ratio valuations that people have done. We've talked about starting with the asset value because that's the most reliable, trying to do your best with intangibles, but supplementing that with an earnings power value, which is what the company is worth in terms of its earnings, if it earns them in perpetuity as it sits there today, and leave the growth and the projections for the future out of your calculation. If you do that, what you wind up with is this picture. Either you're going to have an asset value greater than an earnings power value, which is usually a problem of management, or in some sense you haven't written down the assets enough because you haven't recognized that this is a dying industry where you want to do a liquidation value as opposed to a reproduction value of the assets. The more common case that you would expect is case B, where the asset value, and this is the first case obviously is Hudson General, and there the big issue is going to be management. The second case is Magna, where the assets and the earnings power value are about the same, and you've triangulated a value. It's a value you ought to have a fair amount of confidence in. In that case, the growth has no value, so you don't even have to worry about the growth. There, it's just a matter of being disciplined and waiting for your price. And then when you get your price, when do you think you get a good price on a stock like this? When it has a disease, whether it's the Stronach or the auto industry falling apart or whatever. What that means is you're going to have to be willing to look at that diseased stock carefully in exactly this valuation mode to judge whether that disease is permanent or temporary. And then finally, in the last situation where, like Coca-Cola, you've got enormous earnings power value in excess of asset value, maybe it applies to Amazon, you've got to do a different set of things. Now, I want to talk about some language here, actually, because it's something you're going to come across in the outside world. People are going to talk about investing in good businesses. They're going to say to you, we only invest in good businesses. And then they're going to ask you what a good business is. Now, a good business is something that just generates an enormous amount of cash throw-off. Has high profits and it has low investment requirements. Sometimes if it's growing fast enough, it may not throw off much cash, but even Google throws off a ton of cash. Ultimately, a good business is a highly profitable business in terms of returns on the amount of capital you have to invest in the business. The central reality governing profitability is competition, just as the central reality governing your investment returns is competition among investors, including the ones on the other side of the trade. Asset requirements are one constraint on competition. That is, if you have assets, you're going to have profits that justify the investment of those assets. It's not usually what people mean by a good business. Because for those businesses, you invest $10 billion and you get $10 billion in value out in earnings, and you may or may not pay $10 billion for that in the market. The earnings come from assets plus effective management. You want to look for operating efficiency if you're going to look at these kinds of businesses, and good capital deployment. Mostly the businesses that generate reliable, high cash flow with relatively little investment are, of course, franchise businesses. Businesses protected by barriers to entry. So that ultimately, even though the language may be high return, low investment, lots of distributable earnings, ultimately what you're going to be identifying is businesses that have sustainable competitive advantages, sustainable barriers to entry, therefore, and high returns. So when people talk about good businesses, it's no different from what we've talked about here. What that means is, you think product differentiation is enough. If you think it's all about brands, it's wrong. It's not brands. At a minimum, it's brand loyalty. You have high visibility brands that are not profitable and much lower visibility ones, more prosaic ones that are much more profitable. God help you if you believe in first mover advantages. You ought to remember that chart. You better not simplify this notion of where barriers to entry come from. Barriers to entry come from competitive advantages. Proprietary technology, proprietary resources, customer captivity based on habit, search costs, or switching costs, or, and this is most importantly, and economies of scale if it's going to be sustainable. Ultimately, when you look for markets in which there are economies of scale and sustainable advantages, you have to do the analysis on a market-by-market basis. Large global markets are difficult to dominate. You want to look for local markets in either product space or geography, and a management that understands the dynamics of that. It's going to be a long siege. You guys want to move to the other side and sit down? All right, are there any questions about valuation other than growth valuation, because I'm going to talk about that at some length tonight, or how you judge franchise businesses? Remember, this is your last chance. We've really been clear on this. Now, there's one last thing that I want to talk about franchise businesses, which is often what creates your opportunity. And it is this. Most franchises are shared. Even at a local level, there are Walmarts and Targets and Kmarts in the same town. Coke and Pepsi is a classic example of a shared franchise. Singly dominant franchises are actually relatively rare. If you have a shared franchise, the critical factor is, can these guys get along? That basically, if you think about the possible outcomes, if there are no barriers to entry, you've got a competitive industry, people are going to earn their cost of capital. If you've got a monopoly, it's only you who have the competitive advantages, then you're going to make a ton of money. If you have shared competitive advantages, and the people cannot behave themselves, that is, they try and kill each other, which is never going to happen. Coke is never going to kill Pepsi. They're both going to be around till the cockroaches are all dead. If you have shared competitive advantages and you try and kill each other, it will be exactly like a competitive industry. Growth will have limited or no value. Profits will be just a fair return on capital, and there's going to be no substantial value creation from investment. If they can get along, and I know this is counter to what most people think is the way businesses should behave, then it's going to be exactly like a shared monopoly. So one opportunity for you, if you can identify it, is a situation like Coke and Pepsi in 87, 88, 89, where they had a long history of dysfunctional competition, and they suddenly began to cooperate. And Buffett recognized it, and it was a valuable time to buy them. So you also have to think, and we haven't talked about it much in this course, about how well, in the case of shared monopolies, these companies get along. Now, to growth. Remember, you don't want to spend a lot for this. It's unreliable, people overpay, and you strictly, in the old days, value investors wanted it for free. Do people understand this chart? Is there anybody who doesn't? Because it is counterintuitive and it is crucial if you're going to buy growth stocks. Growth without a franchise, growth where you earn the cost of capital, creates no value. The investment required to support the growth just offsets the benefit of the growing stream. If you're earning less than the cost of capital, growth destroys value. It's only when you grow within the protection of a franchise and can earn sustainably more than the cost of capital that growth creates value. It is only in this situation where you have high earnings power and a sustainable franchise that growth is going to create value. I'll even say it in words. Growth at a competitive disadvantage destroys value. On a level playing field, it doesn't create any value, so you don't care about the growth rate. And it's only at franchise, only in the books part of Amazon that you really expect the growth is going to create significant value. Now, I do want to say something about that, because in measuring franchises, we've talked about returns to invested capital. The temptation is always, once you take the cash off for something like Amazon, to look at these enormous returns of 100% or so. Why are you getting accounting returns of 100% for Amazon? Because there's a huge asset missing from the denominator, which is all that intangible investment in presence on the web, but mostly in traffic build and in obtaining a dominant position in books, CDs, and music. If you did that, if you took full account of the assets that they've invested, and you properly corrected the earnings for any expensed investment in growth, so you really looked at earnings power for Amazon if it didn't grow, what should you see if there's not a franchise business? That the earnings power value and the asset value should be about the same. Remember, you get that earnings power value by the earnings power divided by the cost of capital. If you multiply that cost of capital by the asset value, that's just equal to the earnings power value. In a sense, the earnings power value over the asset value is the true return on invested capital. both after tax. So your best measure of that includes, if you've done it properly, all the adjustments, is this last comparison on whether there's a franchise or not. Now you can go ahead and look at the return on equity, you can look at the return on invested capital that they report, but ultimately you have to recognize those are accounting numbers that are subject to the kind of manipulation that we talked about, where, especially if you take the cash off the Amazon balance sheet, they're basically manipulating that cash number at the end of each quarter. And it doesn't represent the average level of investment. You're much better advised to go ahead and look at an asset value and an earnings power to fundamentally judge the source of a franchise. Anyway, if we're looking to invest in growth, the problem, of course, is how much. And there the fundamental difficulty is that small changes in growth rates and costs of capital lead to large changes in value. The reason for that is that when you are on this part of the curve, which is where you are for most growth stocks, small errors in either the cost of capital or the growth rate leads to huge errors in value. When you're out here for the non-growth stocks, you don't have that problem. So for growth stocks, you are better advised not to try and do it in value terms, but to look at these things in return terms, where the connection between what you can assess, which is a cost of capital and a growth rate, and what you're getting, how attractive this investment is much more transparent than taking the 1 over R minus G. Are there any questions about that? Because now I'm going to go over the formulas. Yes? Okay? I don't know. You're just cowed. And you're, all right, this is it. Now, I will later just write down a formula. I hate to write down formulas because I'm absolutely convinced you will never remember them. So what I'd like to do is go through how you basically look at the return you're likely to earn at the current price you're paying for a growth stock. Now, for any stock, the return always consists of the cash return, what you get back in cash, plus capital gains, which is the value increase in your holding. The cash return is fairly easy to identify. It's buybacks plus dividends divided by the price of the stock. Presumably, buybacks plus dividends are some portion of sustainable earnings. Companies usually have cash distribution policies. For some companies, it's as high as 80, 90, or 100%. For some companies, it's generally 0. Most companies are in the middle. But you have a cash return, which is just the earnings potential divided by the price, which is the percentage earnings return, times the fraction that they distribute to. Are there any questions about that? All right, then you have value creation. And value creation comes, which is the capital gains, from two sources. It comes from active growth. They go out and they open new stores. And it comes from organic growth, which is those same tired old existing stores sell more each year. They do new product lines versus growth in the sales of the existing product line. One requires significant investment typically. One requires often only minimal investment in working capital, especially if you take out accounts payable and look at net working capital. So what you have is, for the gains, an active investment part, and that consists of what you retain in earnings, which is the earnings that are not distributed. It's the earnings power or the earnings return, earnings power divided by the price you're paying, times 1 minus the fraction they distribute. That is retained earnings. What do I have to multiply that by? A factor that tells me how effectively do they deploy those retained earnings. And what captures how well they deploy those retained earnings? It's looking first at what they actually do with the money, and then what return they earn at the margin on that investment, simply divided by the cost of those funds. So if they're investing at the margin in new stores that earn 20% a year on their investment, and they have to pay 10% to the investors, every dollar invested is effectively producing $2 of value. Let me stop there. Are there any questions about that? Because I see frowns. Yes?
So can you go through some of the mechanics of how you potentially calculated ROIC?
Yes. Let's do it for American Express. First, where does the money go? What does American Express do with the 35% of earnings that, as a matter of policy, they retain? Where does it go?
They invested in various cardholders.
They lend it to their cardholders. Okay? They typically don't have a big requirement for, especially relative to the earnings, for just the people who pay their bills all the time. So they lend that money at the margin to their cardholders. What do you think they charge their cardholders on average? Probably about 14%, it turns out. What do they pay for the money, which is almost all borrowed? So the incremental investment really is just an equity cushion on the borrow. So what do they pay for the money they borrow? Probably 3%. So they make an 11% margin on all those loans. And you can check those numbers. I mean, they report, they have these receivables trusts which are accounted for in a way that's completely misleading. But if you undo all the shenanigans that they do, which is partly why we're not going to do American Express, you can get a feel for what those returns are. Worst comes to worst, you just ask people what they're paying on loans under American Express. So you're making 14, you're paying 4, it's about a 10%, or you're paying 3, it's about an 11% interest rate. Then you've got the write-offs, because they don't all pay that 11%. Average write-offs for American Express, because remember, we're worried about long-term sustainable returns here, are about 5.5%. At the moment, they're about 8%, but the average is about 5.5%. So when you see 3, you're not going to take that on faith. When you see 8, you're not going to treat things as bad as that. So I've now got out of the 11 write-downs at 5.5%. So what's the return on every dollar that they borrow? 5.5 cents. How much equity do you think they need to cover that debt? They need at least 12.5%. So on the equity reinvested in that loan portfolio, they make 5.5% times 8, which is 44% pre-tax, which is about 30%, 28% after tax. If you think their cost of capital is 10, they're creating $2.8 of value for those loans for every dollar. Is that clear? It's a matter of looking where the money is going and tracing through what the returns are. Which was the example we did where they were creating no value? Home Depot. They're opening stores. What you have to do is trace through the new store economics. You have to do that for all each.
So it's pretty much an individual process for
It's an individual process for every company. And it's really good for you that it is. Because if you could just jerk around the numbers and get this, extract this from the financials, what could you be replaced by? A computer. And you're much too appealing to be replaced by computers en masse. Yes?
Is there like an element of hidden sensitivity in that if you're looking at an annualized IRR, you extend that over a period of time, then a couple of percent can make a big difference? And
what does a couple of percent add in this case? Let's say the couple of percent.
Well, in this case, yeah, I guess it's a huge.
Well, no, the worst it can be is if all earnings are retained and you add a couple of percent to the return on invested capital. You'll basically add a couple of percent to the value of retained earnings. So if you're off by 2%, what are you going to be off in your total return number? 2%.
Over 10 years?
It's 2% a year.
Yeah. Right.
It's 2% every year. And if the cost of capital is higher, you're going to be down by that amount. That's why we're doing this. Because you don't have to say over X years and do a complicated formula. The fact is that when you annualize the IRR calculation, it becomes much more transparent. The problem you had is that in 6301, I guess, you did these incredibly complicated versions of it that made it seem as if it was hard to calculate, but you depended on all sorts of assumptions that you really were not in a good position to make. And actually, in most of those cases, the timing of the cash flows, the assumptions don't matter much to the overall return. Is that clear? Because that's the central point of issue. Okay, so I've got the cash return, which is just the payout ratio times the earnings return at the current market price. The reinvestment return, which is the percent retained at the retained percentage of the current market price. That earnings return times 1 minus what's distributed, times this factor that describes how effectively they're deploying capital. It could be greater or more often is less than 1. Yes? Yes, it is the cost of capital that you should use is the cost of capital that's appropriate for that investment. Okay? So if you think that the loans to customers are more risky than American Express's basic business, and you think in order to fund them at an 8-to-1, a 12.5% equity ratio, you would want a 12% return on that equity. Then the denominator here would be 12, even though you use 10 in the overall earnings power for American Express. That's exactly right. Yes?
Does your model you also the cost of capital in your cash returns? P is below the cost of capital.
This is why I don't do formulas. Step back. Okay, if you buy a stock for $4 and I pay you 40 cents in dividends a year, what's your return? 10%. 40 cents on $4. Okay. Suppose the cost of capital for that company is 8%. What's your return? 10%! It's still 40 cents over $4. Suppose the cost of capital is 10%. What's your return? 10%. Suppose your cost of capital is 12%. What's your return? Your earnings part of the return. 10%. Why are you bringing in the cost of capital at this point when I haven't told you to do it yet? Because you're immersed in a formula. There's a cost of capital up there, and you think, hot damn. I get to think about that. This is really straightforward. The formula is just a way to summarize the absolute common sense of what we're talking about. You get an earnings return. Some of it gets paid out to you. That's your cash return. Some of it gets reinvested. That times the effectiveness of the reinvestment is your reinvested return. Then you get organic growth. You get same-store sales growth. You get billing growth for American Express. You get growth in sales for particular items and so on. And that typically doesn't require a lot of capital. And it happens without any conscious investment. Now, why do, except for inflation, non-franchise businesses not get organic growth? Because entry eliminates the profitability of organic growth. If you've got barriers to entry, you keep the same store sales growth. If you don't, more stores crowd in, and they eliminate that profitability. Okay? So you've got the cash return, the retained sort of reinvestment return, and then you've got the organic growth, and typically that's going to be some relation to GDP. either higher or lower depending on whether this is a product for rich people or poor people. Rich people will be higher than GDP. If it's Walmart, it'll be lower than GDP. And whether it's services or goods. Goods are growing less rapid. Demand for goods is growing less rapidly than GDP. Demand for services like medical care is growing more rapidly than GDP. Did I really answer your question, or did I just do you with science?
A little both. I understand why IRR should not be respective of a required rate of return, but
Hold the phone. It'll be clear in just a second. Okay, so this is how you calculate the prospective return. Once you've calculated an IRR, what do you do with it? You compare it to a market return. You compare it to your cost of capital, right? Is it easy to see how that cost of capital enters in this little equation? It sure is, right? And isn't that all you do with an IRR? You calculate the IRR first, and then you compare it to a cost of capital.
yes.
So when you calculate the IRR, does the cost of capital enter at all?
No.
So when we calculate this simplified IRR here, does the cost of capital enter at all?
No.
Where does the cost of capital enter?
When we compare it.
Right, exactly. Now is it clear?
Yeah, but now it's unclear why the cost of capital in the growth section.
Aha! Why is that? Why does it matter in the growth section?
This is like a double counting.
No? Okay. Suppose again, the way to think about these things is to do simple mental models of what's going on. Imagine that instead of the company investing it itself, it takes the retained earnings and it hands it to another company. And that other company invests it. If I give that other company $100 million, which is over my $4 million market cap, is 25%, the 25% earnings. What determines the value of that $25 million?
Return on investment.
Exactly. Relative to what?
Your
Cost of capital. If they just earn the cost of capital, so they earn 10% of the cost of capital is there, how much value do they create with that $100 million? No, the $100 million.
$100 million.
They create $100 million in value. Okay? If they make 20 and the cost of capital is 10, how much value do they create? 200. If they earn nothing and the cost of capital is 10, how much value do they create? Right, they create none. They destroy it all. So does it matter what that return is? For what you're getting out of your investment in the case where they give it to another company? It does. And in fact, what's the cost of capital that's in the denominator in that case? Where's my expert back there? Somebody brought this up. We actually had this discussion. Yeah. What's your name? Sorry? Galibo? Galibo, explain to him what cost of capital is in the denominator. In this simple example where we give it to a second company. Right, of that other company. So now we're not looking at giving it to another company, in which case the economics of it and the calculation are clear. We're reinvesting it ourselves. Is there any fundamental difference between us giving it to the other company and our reinvesting it ourselves? Okay. So do we have to know the incremental cost of capital on the investments we're making? Okay? Is this still confusing to you?
It is, but I
The reason it's confusing to you is that you're used to thinking of IRRs as incredibly complicated calculations that are non-transparent. What this simply is a transparent way to calculate, once and for all, assuming there's a reasonable steady state, what an IRR is. And it focuses you on the crucial things. How much do you get in cash? How much do they reinvest? And how well do they do it? How good are they at capital allocation? and what organic growth is there that sort of juice up the returns on cost. Now, all those things are in the complicated calculation. But the point of doing it this way is that it is a simple version of what's going on with a very simple connection between the things you have to investigate and the return you're likely. Okay, now, I'll tell you a story about this and then I'll comment. You will, if you're in the next class, which is sort of the legend class, you will hear from a great investor named Glenn Greenberg, who, along with Buffett, is really the person who probably has pioneered this, although they don't talk about it. Who, until he got into some recent trouble, which I think is to some extent temporary, had returns of 23% going back to 1990. Now, for the first 13 years of his 26-year career, he did these simple calculations. He didn't do models. He did simple, straightforward calculations. For the last 13 years of his career, he hired MBAs who did complicated IRR calculations for him, which he then compared to the earnings per share. What do you think was the difference in his returns between the first 13 years and the second 13? Zero. Except that in the second 13 years and the last 2 years, he got in real trouble. And that's because I think he took his eye off the fundamentals and got caught up in the numbers. So which way do you want to do this?
Absolutely the first 15 years.
Thank you. Okay. Basically, there is one other thing that you can do. So this is the formula for those who want it. The earnings return times the fraction distributed plus the earnings return times the fraction retained times the value created factor plus the rate of organic growth is GDP plus or minus. Yes?
Looks to me the formula that we're taking on the additional return, the growth for next year.
Yes. And what are we assuming?
That we're not going to invest in the future.
No, that doesn't change.
Yeah, but shouldn't that be a good?
We're assuming it's perpetual. But is that really what we're assuming? If look, suppose this number were 20% for some company, and we thought that the cost of capital was 10 for that company. Would we expect to earn 20% forever? What typically happens? I mean, look, we had an enormous fight at the fund I'm on in investing in American Express when it was $10 a share, and this perpetuity return was 40%. Did we get that 40% really in perpetuity? What happened? We blinked and it was at $40 a share. Thank God it's going down. Maybe we'll get another shot. Why are we doing this calculation? Because we actually expect to get this return, or because we want to know if this stock is a bargain at its current price? Don't nod your head. You got to give me an answer. Bargain or actual estimated future return? We're looking for it to be a bargain. And the assumption we're making is if nothing changes, including the current price-earnings ratio, this is the return we ought to get. If there are positive developments in growth rates or in return, improvements in management capital allocation, what's going to happen to our returns? Is it going to be higher or lower? If there are adverse developments in those areas, is it going to be higher or lower? Lower. But if we have an adequate margin of safety above the cost of capital, where are we going to be? Reasonably well off. What do you think the target return for Glenn Greenberg was? It was 15%. For Warren Buffett, it's 13%. What was Glenn Greenberg's actual return over this period? 23 to 24%. What was Warren Buffett's return? Much higher than 13%. So what we're trying to do is answer the question, is this growth stock a bargain? Is that an easy question to answer by comparing a value to the market price? No, it's not. It's not easy for anybody. Why? Because the value is incredibly sensitive to these assumptions. What's the effect of a 1% increase in organic growth on this return? It raises it by 1%. That is a transparent relationship. What is the effect of a 1% increase in the required cost of capital on our margin of safety? It reduces it by 1%. What are the effects of those 1% changes on 1 over R minus G, which is the multiple you apply to your cash flow to get an estimate of value? It's huge. So which is a more effective way to lay out the crucial information? This way, or looking at a value that you're going to compare to a price? Okay. You do that, and Tano and I will be on the other side of the trip. I mean, the way this has come up recently, too. People are paying pretty much 20 times after-tax earnings for brewing companies. Do you think there's a lot of growth for brewers in the developed world? Do you think they have high-yield reinvestment opportunities? No. So what are they buying those brewers at? 5% returns, at best, assuming they don't piss it away by buying other brewers at 20 times earnings. But is it easy to justify 20 times earnings in terms of cost of capital and growth rates? How do you know it's a really stupid thing to do? It's check to see if the return makes any sense. Okay, so I would advise you, if you're going to do growth stocks, not to do valuations, or you're going to get in real trouble, or the investment bankers are going to get you in trouble. I would look at the implied returns that you're going to get, because you'll get a much more accurate picture of what's going on. Also, you can check those implied returns. So if you want to know if recently things have been like over the last 5 or 10 years, developments have been favorable or unfavorable, you can compare that return number to the actual realized return, which is the dividend return plus capital gains. And that provides a check on whether you're getting a reasonably accurate or a hopelessly optimistic number there. Usually, these gains historically are very often much greater than that. You probably want to stay away from those stocks because they tend to be really overpriced relative to the cost of capital. If, in fact, though, a growth stock has a blow-up, then these gains will probably be reasonably in line with that because all the optimism that drove the past price trends is going to go away. But it is a check on how accurately this is driving market prices. Then what I have to do is compare that return to the market return and ask, do I have an adequate margin of safety? Now, of course, to do that, I've got to estimate what a return on the stock market is as a whole, because this may be more or less risky than the stock market as a whole. There are 2 ways to do that. You can either take an earnings return on the assumption that reinvested capital just earns its cost of capital on average, and the organic growth really that matters is only inflation. That number is about 6% today. It's a 1.5% probably long-term rate of inflation. It's 7.5%. Or you can look at a cash return plus the capital gains. Capital gains for the economy should be driven by growth in earnings. earnings are usually a pretty stable fraction of GDP, so earnings growth and GDP growth ought to be about the same. Global GDP growth in nominal terms is probably about 4.5. The dividend return on major stock indices outside China is probably 2.5. You get a 7% return. So buying the market portfolio returns about 7 to 7.5%, maybe 8, and you want to compare your return to that. Now, what should be in that market? Yes, go ahead.
How large of a margin of safety would you require?
That's what we're going to talk about. What do you want in a margin of safety? Well, I mean, you can tell from the numbers that Glenn Greenberg uses, that he wants 15 over his investing life. The market return has probably been about 8%. So he wants almost the same 2-to-1 margin of safety that you want in valuation space. For Buffett, it's 13%. You'll notice that if the return has been 8, that's about a third. And again, that's exactly what has been around in the valuations on the left. Now, another way to think of that is, what does the sustainability of this return depend on? What's the thing that would most undermine this return? What's the adverse future development that's really going to kill you? The loss of competitive advantage. And you know sooner or later most competitive advantage goes away. You think it's got a 30-year half-life? What's the probability of losing the competitive advantage every year? About 3%. So at a minimum, what you want to cover is the probability that the franchise goes away times the loss in value when the franchise disappears, which is what you're paying for the franchise company is what you lose, and what you get is presumably the asset value itself. So you could look at what that number looks like. The ratio of asset value to sort of total value, that's about probably 4 times. So you'll probably at most salvage from Amazon 25 cents on the dollar. And what's the likelihood that the Amazon franchise will be around in 20 years? I think it's not too high. So it's a 5% erosion rate. So a 5% erosion rate, and you recover a quarter, is about, you lose 3/4. So you're losing about 4% a year. And you want that in your margin of safety. So a big element to the margin of safety is going to be this potential for franchise erosion times what happens if the franchise dies. Now, what I'm really worried about is there are a lot of people sitting here completely flummoxed. I wish you would ask questions if you are. Because these are fairly sophisticated questions. And I'm hoping that, yes, go ahead.
Sure. I guess when you're comparing this against the return on the market, though,
Right.
maybe, because so at times when the market's really overheated and stupid, you're going to demand, this would say that you're demanding actually a higher return for some of this stuff if you want a 2-to-1 spread or whatever it is, when actually at the time you might be willing to take
Right,
less.
but notice, how are we calculating the return on the market? If we did this in late 1999,
Doing like a 10-year trailing or something like that. Yeah.
well,
Clear.
kind of was going to talk about that later today. But think about how we would assess a market return. Well, how I just did it. Suppose we were in 1999. What do you think the return, let's just do tech stocks. What do you think the average multiple on tech stocks was? Well, the multiple was probably 30 times. So that earnings return is probably 3%. The dividends were at most 1%. The growth rate of that sector, it might be faster than GDP, but not that much faster than GDP, is maybe, what, 6%? 4%? So it's maybe a 7%, maybe a 6% return. Since none of them actually had any competitive advantages, you're probably just going to get GDP growth out of that, which is 5, maybe 4. So you've got a return there for the market as a whole, right? You're going to compare that to the return you're going to earn in these stocks. Is there anything in this formula that depends on the level of the market itself. Do the dividend payments and buybacks depend on, and the dollar value of the buybacks depend on the market itself? No. What's the price here in the denominator? It's the price of the stock you're buying. The retained earnings are what they are. It's your estimate of sustainable earnings not distributed divided by the price of this stock, multiplied by the reinvestment opportunities that they have, divided by their cost of capital for those opportunities, plus any organic growth that's there. Is any of that dependent on the level of the market?
No. I guess I'm talking about when there's a difference between what you perceive to be the risk of the market and the risk of this asset, where those might be.
Oh, but remember, that's relative to the market. And what assets are really high risk? For what assets do you want really big margins of safety? What's the safe part that corresponds to the assets here in this formula? The cash distribution. The next safe part is the retained earnings, because that has some validity. The organic growth, if you can get an idea of it, is good, but that's where the prayer and the dream is here, especially if you're going to have it higher than GDP. So what does this tell you about when you're going to have high risk? What are the stocks that are going to be high risk in these terms? The ones that have no dividend yields, very low earnings yields. And there you're going to want to return probably not only just above the market, but above something above. So now I'm going to tell you on the sell side the way you want to use this formula. If this formula has you buying a stock that's trading at a sustainable earnings return of less than 4%, you are probably making a big mistake. So when you get to 25 times sustainable earnings, you ought to be gone. I think if you go much over 20 times, you're asking for trouble. Does that answer your...
Yeah.
Go ahead.
What does the TV mean? What's the total value?
It's the total value of the stock plus the franchise. It's what you're paying for the company. What you're paying for, look, what you're paying for is the value of the franchise. Right? If the franchise goes away, what are you left with? The value of the assets. So what fraction of that value of the whole company do I keep if the franchise disappears?
Right. But you just said that we shouldn't use this to calculate value.
What value am I putting in there? It's the market value.
So it's just the market cap.
It's just the market cap of the company. Okay? Because that's what you're paying. That's what you want to get back in some sense.
Right.
The franchise goes away, are you going to get that back? No. What are you going to get back?
Yes.
The assets. Okay? So that's just, we're not estimating it. Yes? Is that what we're assuming here? What assumption did we make about reinvestment here? So we did change that IRR assumption. What was the assumption we made here? That we were going to investigate where that money was going. And we were going to look at the likely return they were going to earn, as in the loans for American Express or the new stores for Home Depot. And we were going to divide by a cost of capital for that investment. So in fact, are we using that part of an IRR formula? No. That is the weakest and stupidest part of an IRR. Okay? No. Is the money on the balance sheet worth anything? Is it worth nothing? They accumulate cash. Is cash worth nothing? Does it earn interest? If you held the cash, what would it be worth to you, even if you didn't spend it? It would be worth the value of the cash because it would accumulate after-tax interest at an appropriate reward for the risk you would take. What's the problem with cash on a corporate balance sheet? They pay 2 levels of tax before you get it. They pay the corporate income tax, and then when they distribute it, they pay capital gains tax at what used to be an advantageous rate, and they defer. On balance, they probably cost you money because they're also apt to do stupid things with it. So you've got to take some sort of a hit. But sooner or later, what do you think happens to that cash if they don't sit away? Sorry? Well, but if they don't do that, what happens to that cash? They do buybacks to it and winds up in your hands. So again, you have to ask yourself, what's the likely fate of that cash going to be? And that means looking at what they're still at capital allocation. Yes?
So talking about the safety, we said that we have to calculate probability times the loss rate once a year.
Yeah.
It shouldn't be like 1 minus the asset value.
Yes, it should be. I did that wrong. Okay, you're absolutely right. It should be 1 minus that. That's what you got left. The loss is 1 minus that. I did this moderately quickly. Yes? What if they use cash to pay down debt? No. Does it create net value if they just pay down debt rates? I mean, what's the cost of capital on debt? It's the rate you pay on the debt. What's the return to buying back debt? The rate you pay on the debt. What's the value creation in that process? Yes, but what have you paid in order to get that? The money you've used to buy down the debt. You have to earn a return above the cost of capital for that application. Look, that's a really good example because the cost of capital of the investment project by, reduced debt is much lower than the cost of capital on investing some new store, right? But what's the return on reducing debt? It's also equal to the cost of capital on debt. So is it usually the case that you create value by doing it? The only value you create is any net reduction in distress cost. And trust me, for most companies, that is negative. Yes?
So I have 2 questions. One, how do you use this franchise erosion that you calculated?
Oh, I mean, how did we do it for Amazon? I mean, market return for Amazon say that you're facing is 7 to 11. Okay? I'm sorry, 7 to 8. So say 7.5 is the market return. What do we think is the chance that Amazon's franchise goes away? 5% a year, say 4% a year. What do you think is going to be left after that franchise disappears? They're going to piss it away like the newspapers. So that's a case where what's the total cost of potential franchise erosion? 4%. So at a minimum, what kind of return would we like to see from Amazon? No, because we want to earn a market return too. We want to earn a market return, and we've got potential erosion in the value of 4% a year because the franchise may go away. So we like 11 to 12. Did it look like that was Amazon's return? This is not rocket science. I mean, I think you're all trying to complicate this much more than it needs to be complicated. Notice even when I try to do a formula, I got it wrong. Yes?
For all of you that lost money shorting Amazon, what are some lessons learned here?
We're going to talk about risk management. Shorting is a really dangerous way of doing it. Okay, are there any other? Yes?
Just wanted to comment a little bit on how value stocks to also get this competitive advantage of some of the things. At least I associate with big companies, companies that have been around for a long time.
No, that is where you're wrong. What did we say about the source of competitive advantage? How do you have to judge competitive advantage? Is it big, period, or is it big in a particular market? If that market is reasonably small and obscure, is it still a competitive advantage in that market? Do they still get the benefits of organic growth in that market? What is a famous company that did that and also had huge reinvestment returns because they were very careful in their capital allocation strategy? Walmart. Did Walmart start big or small?
Well, I understand that they obviously have to start somewhere, but it seems like if you wouldn't invest in Microsoft until...
No, of course you would. What distinguished Microsoft and Intel really back in 1984, 85, 86 from IBM and Apple? Why would you not invest in Apple, but you would consider, depending on the price, investing in Intel or Microsoft in the mid? Now, it could be it's just too expensive and you don't want to pay for the growth. But what is the difference between Intel, Microsoft, Oracle on the one hand, and Adobe on that hand, and Apple and IBM on the other? How?
Their specific strength and using everybody else's.
Don't tell me about specific strength. What market did Adobe go after? Fonts. Is that a big market or a small market? It was a tiny market then. What market did Microsoft initially restrict itself to? Operating systems. What chips did Intel only do? It got rid of all its other chips in 1985-86. CPU chips. What kind of software did Oracle do at the beginning? Only database software. What did IBM and Apple try and do? All of them. Now, I want to go back to my friend here. Has he been sitting in this class? I think so, right? This is not your first visit to this class. What are his natural instincts to do? What do you think the odds are? I hate to do this to you. What do you think the odds are he's going to be a real value investor 2 years from now? Maybe after this incident, higher than they were before. But you have to understand how your instincts work. It is non-instinctive to look for small niche companies. Your instinct is absolutely right. Everybody looks for companies that are big and well-established after they've grown. And are you ever going to get a bargain in those companies?
No, and I understand that, but I'm just saying Microsoft, just because they were focusing on one area in 1984, didn't mean they were going to become have a competitive advantage.
No. Oh, yes, it does. If they dominate that area, do they have economies of scale?
But I remember even when Bill Gates came and spoke, he was like, look, for the first 7 years or 5 years, we were nobody. We were just like, there's 100
Let me ask you this. Were you captive customer how old were you in 1983, 84?
I was 34.
Okay. Were you a captive customer to Microsoft then?
No.
You didn't know it, but yes, you were. Everybody had MS-DOS operating system. And it was very hard not to do MS-DOS. About 9% of the people had Apple systems, but what happened to them? So they had customer captivity, and what else? Local economies of scale in developing operating systems. What did IBM try and do in 1984-85? They tried to wipe out Microsoft. They developed their own operating system, which was PS2. How did that do? Why?
For all the reasons you just said.
Okay. Look, what I'm going to do is you have to come back, but I'm going to give you a 15-minute break, and then we're going to go on to talk about review and risk management, and then Tano's going to talk about markets. You should have a feel for the value approach to search and evaluation.
I think we should skip it.
No. Okay.
It's up to you. We're putting all those up, right?
Yeah, all those five. No. Look, this is a half-life. This is a Kasana rival. Kasana and this is how much you one minus this is one. If you lost 100%. The asset value is zero. So the franchise cost right. Zero. The asset value is 100 million. It's the asset value. We've got no That means what's the loss? Well, it's the margin of safety. This is not. This is the margin of safety. That is covered. And you want this loss in margin of safety. Yeah. I don't want to know why you never said that anymore.
Yeah, exactly. I told you it might be a little bit.
This will talk about the policy.
But it actually occurs. Think about when billings go up. You have so the truth is there's some investment which is associated. Sure, I guess. If you have to build a new store, that's more investment. You have to, because that's an asset. You just have to add the inventory. And it's the inventory minus the discount. So there is a calculation you have to do. Yes, good work.
I apologize.
No, it was great.
It was a honest question. Anyway, on the very first example, I just lost one number. When you said 5.5% times 18.
Times
8. All right. What would you think?
If you do $1 of loans, you make 14, pay 3, and you lose 5.5.
Right.
And that's 5.5. You don't actually lend out the equity. You use the equity to support this debt of 3%. So for every $1 of equity, how much do you think you can make in loans? I'm assuming that for every $1 of equity, that's why I don't think it's you got $1 of equity, how much do you think you can afford to borrow and lend to? If you lend $100 of equity, right, how much risk do you want?
No party?
And what's the credit card?
What?
$8 of debt. So each dollar of equity does $8.
That's right, half.
So I earn 5.5% on $8 for each dollar of equity. That's 44%.
And moving. Where? Near my just get into the better weather. It's not really the ideal weather to move. Kind of promise people to move out. Level is so I'll try to make the transaction easier by cooperating. It looks like I'm getting myself into a very bad deal. Like in this class, I have to come here twice a week, right? And then I have the first week of March. Are you auditing or your?
Yes.
Oh, okay, so it doesn't matter. I think after today, you don't even need to come. This is the last lecture. Okay. Next will be case, and then after that it will be some sort of a guest book.
No. Because once you do that, you have all the problems of how imprecise it is. You have to exercise judgment. What did I tell you?
Studying this, the other class,
started 20 times earning.
teaching the missile line.
The reason is
What would you look at it? I mean, it's like I think it's the one like two set. I mean,
there's no way you can back out of price without having all the
different people have different strategies, and ideally you have 3 or 4 twos in your two set. It depends on and then I think the one thing I like about it is that any conclusion is not independent. You can kind of triangulate from multiple aspects. That's kind of important. So that's kind of help you. So when it comes to daily work, if I ever get to work in this industry, then it will probably take me 5 to 10 years to build.
I think that.
Right? And then within the 10 years, I'll probably for every investment I take, I'll do 5 different evaluation models, and then
Run it all the way up to 40 times.
and then it's just over the year also you kind of
Never do that
figure out not only which one works best for you, but which model you're most comfortable with. And
I know it's intelligent. Eventually,
that's the wise way to say it. It just historically, if you look at the value investors, that never performs throughout the 90s during the dot-com bubble, so I think they will be in fashion this decade, first decade. So I think the take-home point is, in trading there's something called a trend or trend. So when the market is trending, don't go against the whole trend. When there's no trend, it's like no industry to be in. It's very mistake. So it's like, look at the way that you didn't go anywhere. So when you're trending, because you have to be young academics, then you're forced to consider. So you have to be watching between one of the methodology and our favorite. Like is that they are very stakeholder strategy. People never expect why is like a development strategy try to adopt that strategy for a particular market. If I try to make what I'm doing, then they never expect it. All random investors say macro picture, macro condition. What I think
no, I mean a franchise is what?
I'm not acting like you.
Maybe it's getting not that that's
$8,000. Okay. spend 2 hours a day doing the model. Take a look at it and let me know.
And tomorrow?
No, if you do that tomorrow.
Lovely.
Lovely.
No, that's good. Thank you.
Guys, so we're in the home stretch. You want to know what a good search strategy looks like? You want to know what a sound approach to valuation is for non-competitive advantage businesses. Asset value, earnings power value. For businesses with competitive advantages where growth has value, you want to look at a potential return. Next, we're going to talk about reviewing things. That is, once you've done all this, what are the things you have to pay attention to when you do your research strategy? First thing is that the valuation itself drives a lot of the research strategy. If you've got an asset value well in excess of the earnings power value, if we are Hudson General, where are we going to focus our research efforts? What document are we going to look at? The proxy, the company management, what's going to happen to them? Can we get rid of them? If it's not that, we want to do, Mike is not here, but we want to do the Mike dyeing industry haircut. Do we care at all about the growth rate? No, because in this case, growth of anything is going to kill you. You're not going to waste time on that. In this second case, where you have an asset value that's approximately equal to the earnings power value, and it looks like there are no competitive advantages or not significant ones, where are you going to focus your research efforts? And this is really an important thing. You can go ahead and refine the estimates. But what's nice about this second case? You already have triangulated information. So your information is probably pretty good. What that means is you just have to wait for your price. And if your price shows up, you have to make sure that nothing has changed. It's not particularly research intensive once you've done the original asset value and earnings power value. It's just a matter of waiting for your price, and if you've done the work, you can be ready to pull the trigger when that happens. In this last case, where the earnings power value is way above the asset value, where are you going to focus your research? On the nature and sustainability of that franchise. The franchise isn't there, you're not going to pay for the earnings. The franchise is there, you might pay for the earnings and even something for the growth. In these businesses, what do you really care about? You care about the nature and sustainability of the franchise. You care about capital allocation by management. You're going to look at what they do with your money, because you're typically not going to get all that much of it in cash. You're going to look at the growth of the market, and you're going to try and think about the long-term future. 20 years from now, is this franchise going to be there? The answer is no. You've got a fade rate or a half-life rate of at least 5%, and you better build it into your margin of safety. So the first thing is, depending on the story that the asset value and the earnings power value tells, you're going to get a very different research focus. Is that clear? And it's a lot of what we've talked about so far, driven by these valuation techniques. Once you've done that, you've verified the critical factors here, then the second aspect of research you've got to do is collateral evidence. And the first thing is you want to know always what the insiders are doing. If you think this is a great bargain and the chief financial officer has just sold 50% of his stock at this price, you better have your first rethink, because he's better informed about this stock than you are. So you always, as a last step, want to look at what the insiders are doing. Those reports are available. Second, you want to know who your other investors are. And this is, by the way, a perfectly adequate search strategy. U.S. funds are required to report, above 100 million, are required to report their holdings to the SEC. I think they're 13Ds. Yeah, 13F, sorry. They're 13F. You can get those, and typically Bloomberg and other people will list who the big investors are. If the big investors are notoriously unsuccessful growth investors, you don't want to be there. If you see it's other intelligent value investors, that's evidence you want to weigh. You don't want to be driven by this evidence, but you want to know it's there. You might go ahead even if it's stupid growth investors, but you want to know who you're in bed with. Remember, you want to be on the right side of the trade. The last thing you almost always want to do is you want to know what the broad investment community view of this stock is. Not because you're going to copy it, but because almost always a stock that's cheap is a stock that's diseased. And people will write about that disease. And you want to check that sell side and other research at conferences to make sure that you haven't overlooked something. That there's not something about this market that you missed. It is deeply reassuring if you've considered everything they think is going to go wrong and you're pretty sure that it's temporary. So you want to look at what the insiders are doing, you want to look at who the co-investors are, and you want to look at what the general market consensus is, especially qualitatively of what's going to happen. Yes?
When you see co-investors that are traditional deep value investors, does that tell you that they've sucked the value out of the trade already? Or that
No, because guess what you can do? Because they have to report quarterly, you can pretty much estimate the price at which they bought. And I'll tell you what almost always happens. You have a chance to buy it for less. So you can have an idea of the range. And there are websites that will do this for you. And you can just look at the stocks where you can get it for less than. Okay? All right, the last thing you want to do research on, in a sense, is your personal biases. And this is actually what we're going to talk about. You have to remember that you, too, are subject to behavioral biases. That these natural human tendencies are deeply embedded, probably for evolutionary reasons, in all of you. Historically, men and animals were safer in the herd. So you're going to want to go with the herd all the time, and you've got to understand that you're subject to those tendencies. That means you have to track your investment decisions. Everybody here ought to have, if they're serious investors, an investment diary. And it consists of why you made an investment and what happened, or why you didn't make an investment. Every time you look at a company, you ought to keep a record of what it was that led you to buy or not buy that company, or if you're really brave, to short that company, and what happened subsequently. Because the key here is, you make a mistake once, that's okay. If you repeatedly make the same mistake, you are in big trouble. And I'll just give you some examples. If you are always optimistic, if you hate to short, you think every stock is going up, you better get yourself a partner who's a pessimist. Because sooner or later, you're going to get yourself in real trouble. If you like certain kinds of companies, if you like my friend over here, good gray flannel companies that make you feel comfortable, you need a grubby slob for a partner who is willing to get down in the mud. And you've got to record the rationalizations you use to buy these companies. So the three things are: have the valuation technique drive your research. It ought to be obvious from the crucial variables here that we've talked about in valuation what kind of research you're going to do. Don't waste your time doing research that's irrelevant. If this is a company in an industry with no barriers to entry, don't waste your time trying to guess the growth rate. Very often, if you're in a commodity business and you have a good asset value, you can spend some time on a short-term price forecast, but that asset value is going to provide you with better long-run information than any price forecast that you make over an extended period. So first, focus where you're going to get the most bang for your buck. That means always start with the basic financials and the kind of analysis we've done in place. Think about what the downside risks are, what the big uncertainties are, what matters for this category of investment, and arrange to collect that information. Secondly, pay attention to good investors, and that means insiders, and don't ignore what's out there. Everybody says never read the street. Never do what the street tells you. And if you're going to be infected by reading the stupidities they write, you're in the wrong business. But you want to know what they think is sick about this company. And finally, and most importantly, you've got to understand your own predispositions. And what I want to do for the next 45 minutes or so, before talking about risk management, is to show you the degree to which you are captive to your own particular view of the world. And this also has some benefit when you come to assess management. And what I want to talk about is how historically companies have adapted to new information. And the history is really badly. That you look at the great companies of the past, AT&T, RCA, Xerox, and Western Union, they're gone. You look at the great industries of the past, they're barely breathing for the most part. You look at Good to Great or Peters and Waterman's excellent companies in 1982, a third of the Good to Great companies are now bankrupt or almost went bankrupt. Of the Peters and Waterman excellent companies, more than half of them no longer met his criteria for excellence 3 years after he did the book. When people do unrelated takeovers and they move into a new area, which is like embracing change, they do incredibly badly. Change is incredibly difficult to deal with. Now, some of what we've talked about should illustrate that. People are not, these by the way are the studies of people doing squares against white background, black backgrounds, and judging how far away they are. People are not good at uncertainty. Faced with uncertainty, what everybody does is tell themselves a story that they then believe to an unwarranted degree is true. By the way, these follow-up studies were the ones where they showed them the different size squares and nobody learned. Now, what you do have to understand, though, about that mechanism is it is unavoidable. When you make decisions in practice, and when businesses make decisions in practice, they are always doing it on the basis of fundamentally incomplete information. And it's in two particular senses. The first sense, which is probably the most important, is that when you look at a market, you sort of try and guess what the participants in that market want, how that market is going to work, and how it's going to evolve. There are lots of different models that will fit the objective data that you have time to collect in the time frame that businesses and investors have to make these decisions. That there are going to be lots of different models, especially if you say, well, this is my belief and I want it to be contradicted. There are lots of different models of the way the world works that will survive that contradiction test. Second thing is that you've usually got to make a lot of detailed choices, and you don't have market research on those detailed choices. If you do not have an ideological view of the world, you are going to suffer from just an inability to make decisions. And the way it shows up in investing is there are lots of smart people who simply cannot pull the trigger. They just have a very tough time actually making investments. And we have a brilliant kid where I work who we actually make an investment for his private account every Friday because he wants to keep analyzing things forever. So you have to have this kind of view. But what you have to understand is that when people make decisions, those decisions are invariably, actually let me not use this page, I got a better page, ideologically driven. Now, the reason this says marketing judgment is that this was research done when I was at Harvard Business School, actually. And when we showed it to the director of research, it was about marketing ideologies, and he said, you can't use the word ideology at Harvard Business School because we're non-ideological. So marketing judgment is it, but it really is an ideology. It's this semi-conscious view of how the world works that when the objective data is ambiguous, actually gives you an answer to what you're going to do. Now, while this is really an individual characteristic, it also gets embedded in organizations. That organizations, for example, have training courses. The training courses typically will reinforce their view of the market. In selection especially, ideologies get enforced. If you think about an interview that you're going to go to, they're going to ask you a question. If your answer to that question agrees with their answer, they're going to decide you're smart and hire you. If your answer disagrees with their answer, they're going to decide you just don't understand. And if you persist in not agreeing with them, I guarantee you you're not going to get that job. But what that means is that both at the level of workers and consultants and who gets promoted and who gets mentored and how the organization reinforces the giving of opinions, these ideologies become organizational. And what I want to do is show you an extended example of how they work in one particular case. Now, remember, there are two dimensions here of company and individual ideologies. One is accuracy. You can have a highly developed view of the world, and it can be accurate or inaccurate. It can be grossly at variance with the way the world really works, what the market really wants, or it can accurately reflect that. Or you cannot have a highly developed view of the world at all. What I'm going to show you is, in this instance, and it's the thing for you to keep in mind, is that this case is much worse than the case of being wrong. Because if you're wrong, you act decisively, you turn out to, things don't work out the way you expected, and you stop doing it. If you're here, you can waste money for a very long time. And I'll show you that in action. Now, the example I'm going to use is the personal computer industry at its inception, which is when everybody, Apple, Hewlett-Packard, DEC, IBM, AT&T, and everybody else was trying to get into this business. The reason for doing that is that it's a new environment for customers, distribution, and so on, but there are no entrenched competitors yet. Nobody has captive customers. There's no embedded old plants that people have to deal with. Nobody dominates distribution channels or have loyalty in distribution channels. There's limited cannibalization of existing product lines. And there are lots of people, Xerox, AT&T, who is the phone company, IBM, DEC, Hewlett-Packard with calculators, who had big image advantages. So there are lots of people who are effectively equal at the starting line here. Competitive advantages were not going to determine the outcome. Also, there were, in all these cases, limited organizational rigidities. R&D was simple and widely available. The manufacturing operations were simple. It was actually low capital intensity. And what that meant was that operating efficiency wasn't going to make that much difference. That it didn't put high demands on operating efficiency. And on the other hand, it's a very complicated market. You've got industrial users, you've got consumer users, you've got lots of different segments. So really, success is likely to be related to how well individual company ideological perspectives did on reading these markets. What I want to do is just briefly give you an idea of what the markets really looked like. Now, this is based on a lot of retrospective. There are three product markets at this time. There are mainframes, there are mini computers, which have been dead before you were all born, and there are micros, which are what are now personal computers, which were then known as micros. What you'll notice is that there are also basically three segments. There are the office and service people who are applications oriented. They were the controllers and the data processors for big corporations. They were people who wanted to do word processing and so on. Then there were scientific and technical people who needed those machines to do equations and do technical things, who were very sophisticated users. And there were home users. And if you look at an industry map, these were the game players, the people, the kids, and so on. There's not a lot of overlap. That in the office and service segment in both mainframes and minis, it's dominated by IBM. IBM has a very weak presence here, and these companies have almost no presence initially in the market for home computers. So it does look like there are these three separate markets. And that suggests, since the basic technologies are the same, that there are three separate markets in terms of what those customers want. All right, so what I'm going to talk about is the history of people, and this is going to be companies attacking this market, and how they went about doing it, how successful they were, but especially how they talked about it. Because this is an exercise in management assessment that you're going to have to do, but also ultimately personal assessment, because you'll hear yourselves saying these things. So I'm going to start with the office and service segment. And that was absolutely dominated by IBM. They came in late 1981, and they absolutely, completely wiped out Apple and everybody else in the market. They did it with a single machine, and it was a standard non-proprietary technology. They didn't build a fancy machine. They didn't care about that. The price they charged was high. In distribution, they wanted tight channel control. They wanted a lot of support for the people who bought these things. And the ads, the famous ads are these Charlie Chaplin ads, but really what went on in those ads were Charlie Chaplin had a problem that the machine solved. And the machine is just a tiny part of the ad. That really it's the narrative story of the problem being solved. Now, they claimed that they did this incredibly accurate market research before they launched the PC, even though they had to make all the decisions over a 3-week period in order to get it out within 12 to 18 months, which is what they did. Finally, we got to look at that research. It was done by a guy at Teachers College here. He predicted in the first year that they would sell 65,000 PCs. That research was so accurate that in the first year they sold 650,000. It was off by a factor of 10. It was a complete joke. But they clearly made the right decisions on these marketing issues. The simple standard machine, the high price, the controlled supported distribution, and the ads that are applications oriented. The way they did it, I think, is indicative. This is how they actually sold it internally, not based on the 65,000 people. These are individual statements made by people we interviewed, but by and large they're common across the company. And this incident where they actually show VisiCalc is the Excel spreadsheet of When they actually showed it to the executives, everybody told us that story. How much detailed, accurate research do you think is at work here? What is the fundamental tool of marketing research here? And it has to do with almost all these marketing ideologies. It is introspection. If they want it, they assume the world wants it. And the question is there an identity between them and the world? This is the way they made the product decision. And again, this is a fully ideological statement. And what it does is, because it's applications oriented, you'll notice it's to make me more money and more productive, which is a classic applications orientation. And what it leads to is, of course, the decision on technology. Because what they want is they want a lot of application software. They don't want a fancy high-performance machine. Estridge was the guy who actually brought the machine to market. He died, unfortunately, in a crash of a Delta airline shortly thereafter. And the funny thing is, and this is what you have to notice is, they recognize that these decisions are ideological driven. That they recognize themselves what's going on. On the other hand, when they go to the PC Junior market, this is what happens. So these are people who've done extremely well. They recognize the force of ideology. And they go into a new market. All the decisions are essentially the same as the PC. They don't alter their ideology because they're necessarily in a new market. And there's a wonderful symmetry. The PC Junior was their little machine for kids and so on. There is a wonderful symmetry to this experience and the PC experience. In this case, they forecast that they were going to sell 650,000 machines in the first year. And they sold 65,000. Now, the interesting thing is, how did they make the mistake? And it's because the decisions are ideologically driven in the same way. This is a classic thing that you heard people say. In fact, when we did a lot of these interviews at IBM, you could almost tell what they were going to say you could tell what they were going to say, based on how long it took them to get to the front desk. So if they came down minutes after you arrived, they were right in the front of the plant. They were in the action, and you were going to hear this standard IBM line. It took them 12 minutes to get to the front desk. This was a guy who'd been put way out back in the beyond, and you were going to hear a variant opinion of what went on. So they applied that ideological view of the world, but it's applications oriented. And people who said things like this, who recognized that it was a different market, or in the case of one of the heroes of the original PC, who said this, we're absolutely not listening to. Notwithstanding the fact that, as you heard, people in this business were aware that there was an ideology at work, there's no awareness when it comes to actually making the decisions of the pervasive role that that ideology plays. And even then, after the failure of the PC Junior, they can recognize that the ideology may have failed, but it doesn't help them ever. This is a deeply embedded ideology in those people. It's embedded in the organization. They purge the people who don't agree with it. And it makes decisions that are absolutely accurate in one case and inaccurate in another. Now, after IBM succeeded, Digital Equipment Corporation, which was the king of distributed computing through time sharing, decided to enter the market. And they decided they would win this market because they were the kings of distributed computing. What they didn't understand is, historically, what had their market been? They had provided things for scientific and technical customers. What they did, therefore, was a set of decisions for those scientific and technical customers that had nothing to do with what IBM had done. They did multiple products with special technical features. All the machines were performance, not applications oriented. The price was high. They had no support in distribution. They basically blew it out in all channels, and they had low channel margins. They just wanted to get the machine out there efficiently. And all the ads basically featured the machine. And they concentrated on PC magazines. Now, they thought they were going to sell 900,000 machines. They sold about 100,000. What they did, however, do was get out of the business, because they understood that they were overwhelmed, although you'll see why they thought they failed is interesting. This is the way they looked at the market. And you want to contrast this. This is Ken Olsen, who was the founder, but again, you hear this throughout the company. You want to contrast this with the way the IBM people talk. This is all about the machine. It's not about what the machine can do. It's about the machine not being a piece of fruit. This is the way they see product development. And again, notice this is completely different. They're looking at the same market as IBM. They're probably higher IQ people than the IBM people. And they come to an entirely different conclusion in talking about the personal computer market and why digital is going to be unique in that market. And this is how it drives their distribution strategy. You can see obviously how it drove their product development strategy. You don't have to market this thing. You produce a good machine, and everybody who's anybody will come and buy it. And the interesting thing is that when they fail, it is the ideology that does the diagnosis. And notice what they decide went wrong, which is the only thing they did the same as IBM. But they are convinced that this was the problem, that high price just wouldn't get it. Now, Hewlett-Packard entered this market after DEC had failed. And they had experience in calculators, so they had some consumer experience, although it was with pretty sophisticated calculators. This is their strategy. This is how it compares to the DEC strategy. Except for the fact that they did some ads in mass media, it is exactly the same. That they do multiple products with special technical features that are performance-oriented and application software doesn't work on. They have high prices, they have low margin, low channel differentiation and distribution. They have technically oriented ads. All the Hewlett-Packard ads, the machine is the star. But they do some mass media, and they fail in almost exactly the same degree as DEC failed. So that even having seen the failure of that performance, that ideology of what the market wants, that had been successful in that market, in their market, that they could not carry across boundaries, was not particularly successful. And if you look at how they talk about it, you will notice it's exactly the same as DEC. And it's wrong in the same exact way. These are systematic patterns of error. It's all about real machines, not amateur machines. This is how they did the product strategy. And again, it's exactly the same as DEC's view of the market. This is the distribution strategy, and again, you'll notice it's exactly the same as the DEC distribution strategy that failed. And the irony is that when they go to do the analysis of why they failed, They focus on exactly the same thing that DEC did, which is the only thing they did the same as IBM. Why they think IBM succeeded with a premium price when they can is bizarre. But these ideologies are extremely powerful because they've been successful in the past, and you have to deal with it. Now, that is what happens when you have a strong set of beliefs. And actually, for both IBM and the PC Junior and Digital and Hewlett-Packard, they limited the damage. The truly destructive things were cases like Xerox, where in Xerox there were two organizations. There was the Office Products Division, run by old IBM people in Dallas, and there was the Palo Alto Research Center, run by these visionaries who basically developed the Mac. In the middle 1970s, they put it on a quite expensive machine called an Alto, but then they could have brought the cost down, and they all migrated to Apple to do the Mac software that is still with us. So Xerox had that technology. It had extraordinary presence and distribution in every office in America. They never managed to really introduce any products. They tended to be feature-focused. They didn't have a well-focused distribution strategy. They had high prices, and they had mixed and changing promotional messages. Sometimes it was the machine, sometimes it was the applications, sometimes it was the software, and they never got together. Now, this is what was going on within the company at the time. This is the head of the Office Products Division. And this is a park researcher. Sorry, am I in the way? Now, this played out, the reason it was so expensive among other things is, this played out over 9 years. So that was the beginning. This is 3 years later. And the Alto is really the early version of the Mac. But again, it was basically machine performance. And this is after 7 years of fruitful collaboration. That's where they got to. AT&T, which has Bell Labs, it has what is now Linux and was the Unix operating system, had the same fight between the Bell Labs people who were scientific and technical in their ideology and the AT&T Information Systems, which were old IBM people. There are enormous losses. They never really succeed in doing anything. You'll notice that there are multiple products. In fact, it gets so bad that they have to turn to the Italians to produce a computer for them. Their best-selling machine was an Olivetti. They had no distribution strategy. It was machine-focused. It wasn't telecom-focused. And they fought for years and lost enormous amounts of money. Now, you might ask, what does it take to actually successfully change these ideologies? So one of the things that I think you should take away from this is these ideologies are deeply embedded, and you better understand what they are, especially if you're going to invest in turnarounds or you've got a company that's doing a new